For the first time in close to a century, we've entered a period of shrinking money supply, meaning that we are now in completely uncharted economic territory, and the consequences this will have on the housing market are likely to be severe. The M2 money supply is now down 4% from a year ago, a rate of decline which is only accelerating every month, meaning that since the peak in 2022, there has been about $900 billion removed from the money supply through quantitative tightening. We have historically seen the M2 money supply grow consistently over time, and even during the worst economic periods in recent history, we haven't seen a contraction take place. For example, even during the global financial crisis around the 2008 time period, we only saw a slowdown in money supply growth, where it stagnated but did not shrink. Other periods of time in history where we have seen a money supply contraction include the 1929 Great Depression, the Depression of 1921, and the 1870s banking crisis, all of which were periods where unemployment was very high at above 10%, and there were numerous bank failures taking place as well. This decline we have seen so far over the last year is absolutely unprecedented, and we have never seen money exit the system at this volume or velocity at any period in modern history. Back in 2020, the money supply increased at a record-breaking pace, partly as a response to what was going on in the world with lockdowns and businesses not being able to operate properly, and money was pumped into the economy in many different ways, a lot of which was given directly to consumers in the form of stimulus checks. And with all of this extra money sloshing about in the system, we saw the price of hard assets like stocks and real estate skyrocket at a pace that we have not ever seen before. The correlation between the surge in asset prices and the surge in the money supply correlates almost perfectly, which does suggest that the money supply does have a significant influence on asset prices. Now the situation has been flipped on its head though, where quantitative tightening is draining the money supply, we're very likely to see hard assets like stocks and home prices follow the direction of the money supply once again on the way down. We have no idea on how bad the consequences of reducing the money supply to this extent will be, and ultimately we could be going headfirst into an economic hurricane later down the line. Another result of a declining M2 money supply is lower prices and less economic activity. Now this is because the money being taken out of the system can now no longer be spent on goods and services within the economy. This reduced demand for goods and services has deflationary knock-on effects and causes prices to fall, which negatively impacts businesses across the whole economy. When businesses are struggling, they are forced to downsize and make layoffs, meaning that the unemployment rate is likely to rise. House prices will of course be impacted by this as well, and due to the reduced money in the economy and declining prices of all goods and services, house prices are likely to fall just like the price of everything else in the economy. And of course, during a period of time where there are mass layoffs and rising unemployment, there are going to be fewer people with enough money to buy a home, leading to a fall in demand for homes. On top of this, we would also likely see an increase in home foreclosures from those individuals who have unfortunately lost their job and can no longer keep up with their mortgage payments. These people who end up in financial difficulty and are forced to sell will drive up the supply of homes on the market as well, meaning that we could be facing a scenario where the demand for homes is decreasing while simultaneously the supply of homes is increasing. This would really be a nightmare scenario for the housing market, where home prices could completely fall off a cliff. The most concerning thing about all of this is that all of these negative consequences from a reduction in the money supply haven't even really begun to hit the economy just yet, and despite this, the current housing market conditions are far from being in a good place right now. It's going to take some time for the economy to feel the brunt of a declining money supply, but as of today we are still facing pretty bad conditions for home buyers and homeowners, with affordability being at an all-time low. Interest rates have surged over the last year or so, and as a result have driven the average 30-year mortgage rate to 6.43% as of today, the highest level it has been since 2008. However, home prices are far higher today than they were back in 2008. In fact, the median sales price of houses sold today is $436,800, a whopping 96.3% higher than the median sales price back in 2008, which was $222,500. Now, of course, if average income has increased by the same rate that home prices have increased by, then affordability remains the same, but of course, this is not the case. Median household income in the US has increased by 40.7% since 2008, which is far less than the 96.3% increase in home prices. So ultimately, this means that with mortgage rates currently as high as they were back in 2008, housing is far more expensive today than any period in recent history. This is shown on the Goldman Sachs Housing Affordability Index as well, where you can see that the affordability has plummeted over the last few years to a level that is even worse than during the global financial crisis. If we do indeed see a large-scale wave of layoffs in which the unemployment rate surges, then this will of course impact household income, and many people will be losing their jobs and therefore losing their income. A declining household income is going to only enhance the struggles that the average household is facing right now in terms of housing affordability. The housing market right now is also being heavily propped up by the current low inventory levels, stalling any kind of significant crash for the time being. The current low supply of homes on the market is one of the major driving factors behind the recent stagnation in the housing market decline, with the latest reading for the Case-Shiller Housing Market Index showing a slight rise in index value. This halts the 7 straight months of declines that we have seen prior to this, showing that the housing market has made a slight recovery. There's always going to be a baseline demand for homes, as there are always going to be people who need to move home and have enough money to do so, as well as investors who are looking to get a cash-generating asset. So when the supply of homes is so low relative to historic levels, it acts as a floor to how low the housing market can realistically fall, as any sort of significant decline in home demand is balanced out somewhat by a low supply. However, all of this could be about to change in the coming year or so, as right now there is an abundance of homes under construction. Looking at this chart, we can see that the number of single-family homes and multi-family homes under construction are both at historic highs, particularly multi-family homes, where there are currently more units under construction than we have seen since the 1970s. This situation is going to cause a tidal wave of new home supply being offloaded by home builders onto the market over the next year or so, on top of the additional supply that we're likely to see from housing foreclosures. All of this greatly increases the housing inventory levels, and if this is not met by an equal level of demand, then the balance between demand and supply is going to shift towards there being too much supply, causing downwards pressure on home prices. Also, as mentioned earlier, a shrinking money supply is only going to worsen business performance and drive up unemployment and consequently housing foreclosures in the future. In fact, we have already started to see a rise in foreclosures in the US, with the number of foreclosure filings jumping by 22% year on year for the first quarter of 2023, extending the period of time that we have seen housing foreclosures trend upwards to 23 months. The CEO of Atom, the provider of this data, states that this uptrend in foreclosures reflects higher jobless rates, ongoing economic challenges, and backlogged foreclosures stemming from government interventions being lifted that were helping struggling homeowners during the pandemic. The unemployment rate right now is still at historically low levels, so it's definitely concerning to see foreclosures trending upwards already. Foreclosures are only going to grow as the unemployment rate rises, and depending on how high it does get, we could see a truly extraordinary number of foreclosures taking place. Especially because the government has done so much to support struggling homeowners in recent years since the pandemic, but now that this has been stripped back, we're going to see a truer reflection of just how many people cannot afford housing right now. It's not like consumers are in a particularly strong financial position right now either, and the cost of living crisis has taken a significant hit on people's savings. The personal saving rate is now at 5.1%, meaning that consumers are now saving approximately half of what they were doing at the start of 2020 and have rapidly depleted their pandemic savings. This has also forced many people to turn to credit cards to pay the bills and keep up with their current lifestyle. Consumer credit card debt is about to hit $1 trillion and has risen at the fastest pace that we've seen in history since spring of 2021, where it was only $738 billion. The average interest rate on this credit card debt is 24.2%, which is going to be a crippling expense that lingers over many consumers who have racked up debt and will put a dent in their overall finances. The simple take from all of this is that consumers on average are not in the best shape right now to simply brush off rising unemployment across the whole economy, and there are little to no savings left in the tank to absorb being laid off and no longer having any regular income coming in every month. This only enhances the argument that we are likely to see foreclosures continue to surge in the coming years. And to add to all of this, many homeowners are currently locked into a low mortgage rate right now with their current home, much lower than the current market rate. This is making some households reluctant to move house right now, and many are actually unable to move home right now due to how expensive it would be to take on a new mortgage at the current rates. For example, if you took out a 500k mortgage for a home valued at 550k back in 2020 or 2021, you'd have a mortgage rate in the 2 to 3% range, which means you'd have a much lower monthly payment cost than on today's rate. In fact, the exact same mortgage at today's 6.43% mortgage rate would cost you $3,565, which is more than $1,000 more on the 3% mortgage rate. Because of this vast increase in housing costs for those buying a home today, many homeowners simply cannot afford to move house right now. And even those who can afford it are very reluctant to do so and would have to downsize and settle for a less valuable home to keep their monthly payments the same. But the problem is that many people are forced to move home for a variety of different reasons. Maybe they need to relocate to a different location for work or live nearer to their family, or maybe they are simply having a baby and need to move to a larger home. Ultimately, there are always going to be people who are forced to move home for whatever reason, and as we see more and more people be forced to move home, we're going to see a large portion of these people actually not be able to afford to buy a new home. And this will mean that they will be forced to rent in many cases, which means that they will be offloading their home onto the market and increasing the supply of homes, but they won't be buying one to replace it. Now, this trend of people being forced to move home but not being able to actually buy in their new location and being forced to rent instead is going to contribute to driving up housing supply as well. And as we know, greatly suppressed housing inventory levels are currently propping up the housing market quite significantly and stalling the decline in home prices. Therefore, more supply hitting the market just adds to the likelihood that we see a housing market crash play out in the coming years. Another significant thing that could exacerbate the future housing market crash is investors running away from the housing market altogether. We've seen a lot of investor panic in recent months, and I cover all of this in more detail in my recent video, which you can check out on the screen right now. Aside from that, please leave a like if you enjoyed the video, be sure to subscribe as well if you want to see more in the future, and thanks a lot for watching.